All right, folks, this is going to be our algorithmic lecture and discussion on price action model number 7. It's a universal trading model. It specifically targets the sell side low resistance liquidity runs and fractals. So obviously I gave you a little bit of a long one for model number 6, and a lot of the things I said in model 6 algorithmic lecture is obviously reversed. So this one won't be as long because I'll be just basically saying the opposite of whatever I said in the previous model. So I kind of want to leave you with ideas that when you're looking for trades and you're looking for setups, whether you're a short-term trader, a day trader, or a scalper, or swing or position trader, the main thing is looking for these types of setups. Okay. Now, initially, when I first set up to be a trader in 1992, I was overwhelmed, obviously, with a lot of the things that my uncle used to talk to me about when I was 15 and 16 years old, and it would go in one ear out the other. And over the time of learning and enduring a lot of hardships, I have discovered that the fastest markets are going to be the markets that decline. Okay, it's easy for people to want to pull out and not want to be a part of the game. Okay, and that's why I believe the market goes down as fast as it does. It's not because sellers are pushing it down. It's the fact that the market is rushing to get them before they get out at their own price. And what do I mean by that? Well, think of a stock market crash. You know, when they crash, or any market crashes, it's pretty relentless. And the relationships of the sell side low resistance liquidity runs versus that of the long side, or buy side low resistance liquidity runs, the sell side generally performs the most aggressive, the most ferocious. They're speedy. They're very quick. They're violent. They can tend to be a little bit more volatile, and the magnitude of the move tends to be much more exaggerated than that of a buy-side low resistance liquidity run. Okay, so what do I mean by that? Let's just say we're looking at a bearish market, and we have anticipated the market running up into a period of resistance of some sort of premium PD array. We're looking for it to sell off. And when we get to second stage distribution, while I teach you to look for this area over here, it's important for you to also consider the intermarket relationships, the macroeconomic and geopolitical front that's at the time of the trade that you're taking. And there's a lot of things that could lead to a major meltdown in the marketplace right now at the time of this recording. So in 2022, we could be looking at things that would send these markets rocking and reeling. But putting that aside, I mean, some of you are like, oh, he's bringing out a tinfoil hat. No, not here. But the second stage distribution, when the market's bearish, it's important to note when this is forming, is it likely to create an overzealous, an exaggerated type of sell-off? Because not every short opportunity is going to create that. But if you're in a climate where it presents that opportunity, for instance, consider crude oil. A little while back when we watched it go negative $40 a barrel, it created a scenario like this where it was just parabolic, just kept on going down. Now, that was a real supply and demand factor because it's a commodity. Commodities are real supply and demand markets. It's a real thing, folks. Okay, you need oil to run machinery, automobiles, things like that. And when they shut down the economy and you just simply can't turn off the pumps and the wells, rather, it takes a little bit of doing to make that stop. So they have to keep pumping oil, and they were basically paying people to come get their oil. So that move where it just completely just fell out of bed, just blew out every objective. I think I had like $11 was my target for oil. and it, it just went right on through that and went below zero. And I would have put my entire fortune on it and would never have done something like that, and I would have lost. So it's a testimonial to understanding how when these markets are primed to go down, whatever market it is, if we're looking at second stage distributions like this in a market that's bearish, it's really important to do an extra lap or two in your analysis to see, can this over deliver from what you're expecting? Can it go way beyond that? And most of the time it won't. Let's be fair. Okay. But it's important to note, and I wanted to draw a contrast between that of what I was giving you for the buy side low resistance liquidity run signatures in the market maker models versus the sell side low resistance liquidity run, because these markets are designed to take from you and whoever else participates. Obviously, the idea is they sell the idea or commodity or currency or market. Okay, they are the seller. They're the sell side of the market. So they're providing the liquidity to buy something. If they want to reprice it lower and get liquidity below the marketplace, they're going to aggressively go lower faster because it's going to drive those sell stops or sell side liquidity into the market for them to cover and buy from. And that's the reason why when these markets are crashing, they create these parabolic, real sudden, where it's almost instantaneous. 1 minute it's at one price and then it's down so much. You hear about it called the flash crash, and they blame it on all the things that would otherwise be accepted because of people just don't know. But these markets reprice because they want them to be repriced at that level. And you have to be careful and be able to discern when you're looking at these types of setups here, second stage distribution on a sell side low resistance liquidity run. This is those setups that really over deliver and go way beyond even my best objective or targets. So that's different from when we're looking for buy side low resistance liquidity runs, and it's a second stage reaccumulation where you're trying to buy that second little retracing before it blasts off. Now, you will catch parabolic moves when it's extremely bullish using that for model number 6. But I want to draw a stark contrast between that of the buy side versus the sell side low resistance liquidity run. Because this one here is what everybody is fearful of, but they don't know how to find them. So when the market's conditioned to go lower and everything is at this point going down, and it creates this model here, second stage distribution can be a amazing sell-off point where you can see it coming. And there's been a few times where I was in markets where I've read them wrong early on in the late 90s. And because of my understanding about this fractal and the understanding of how price is delivered, it kept me from getting caught in limit down moves in the meats, in the grains. Okay, I was looking at markets thinking I was going to try to catch the bottom, and I just was doing it foolishly. I was admittedly taking a gamble, but because I was able to see these types of things here, it prevented me from holding on. And then if I would have held on to it, my account would have been locked limit for a few days. And it's not fun if you have 10, 20 contracts of something that can move a lot. So on the sell side of the curve of a market make buy model, this isn't going to be as bearish as the one I just described, where this is more or less, it's going to be parabolic for a short time to get to an objective we're looking for. Versus, let me go back up one slide, where this one's already part of a bearish market move, and we're expecting it to go up to some kind of a premium just to see them send it lower again. So this is just like the last bus stop before you head into Tallahassee. Okay, versus this short, where if you go into second stage distribution here, we're not expecting, or wouldn't expect, where we wouldn't expect a parabolic crash, where we're seeing a controlled demolition to a level where we anticipate seeing a return or a reverse from here to start going higher. So when you're looking at your markets, you want to make sure you're trying to draw a distinction between what type of move are you looking for. Even though you're in second stage distribution or second stage accumulation, whether you're bullish or bearish, you have to make a distinction between what type of move should it be. Is it controlled demolition where it's going down to a level that you anticipate seeing support being found? It moves from that discount to a premium. Or is it likely to fall off a cliff and just completely melt? Those distinctions need to be considered when you're doing your analysis. If you fail to do that, one of two things can happen. Number one, you can miss an amazing opportunity to capture a windfall profit, or you'll fall victim to that and not see it coming. And worst case scenario, be offside and you just get smashed. And in those types of moves, you can see your stop loss doesn't do the best job because it can reprice beyond your stop. In the first traded price, that's where your market order, well, your stop would be triggered, and it becomes a huge amount of slippage from where you hoped that your stop would execute versus where you're actually being filled because the market price has moved way beyond your stop loss. And I know that sounds like it shouldn't be possible, but that's how the market works, folks. I mean, that's the basis of liquidity and repricing. And that's the reason why I teach this way, because I want you to understand that you want to be doing the most work in determining what side of the marketplace is likely to deliver. So that way you're really putting an emphasis on you trying to be in sync with the market versus trying to pick a top or trying to pick a bottom. And at first glance, a neophyte or someone that hasn't been spending any time with me would consider this as someone trying to pick a bottom, and it's not. The assumption is this is already a bullish market, and the market's consolidated, broke down, returned back to consolidation, first stage distribution, second stage distribution that takes us into a level where we anticipate a measure of support. Then we look for a turn, okay? So this can be applied to a intraday basis or a market reversal, like say New York reversal profile, or it could be a weekly profile where this is Monday and then Tuesday, Wednesday, Thursday creates the low of the week and then starts to trade higher, and you get a completely reversed weekly range where it completely takes out the high of the week and closes above it, or it doesn't necessarily have to close above it. But this fractal, much like I mentioned in model number 6's lecture, is universal. It can be applied in all time frames. And knowing the distinctions and that characteristic that model 6 doesn't have, whereas model 7 does, because it's focusing on the sell side of the marketplace, you're looking at the relationships of a market maker buy model that should not present a crash scenario. This is just going to go down to a discount to go higher. Whereas the market maker sell model in its second stage distribution, if you are not considering the overall economic climate, the geopolitical climate, look what we just went through with the COVID nonsense. Look at what we were about to go through again because of all the things that they're trying to cook up. So they're making a scenario for the fall of 2022. That means like late last week of August to September, October, November, in that vicinity. We could see some pretty crazy declines this year. Much more violent than some of us might expect. Especially if we do not continue higher up in the stock indices. Like we've had a little bit of a retracement here higher. If it has run out of steam, or if it goes up a little bit more and then peters out and starts to go down, and we're working lower into the month of August, that really sets the stage for, in my opinion, that type of scenario right there, where we are in an area where that can create that second stage distribution that is absolutely bonkers. Like it could create big declines because there's a lot at risk in the U.S. markets because of the midterm elections, all the things that's going on, and food prices. Food prices are going to create situations where that element for a bullish market because commodity prices are going up. The sell models, okay, would create these types of events where it's going down, but it's going to go down to pick up the discount to send those commodity prices higher, like grains and meats and like the energies. I think the energies are going to go ballistic. Like crude oil, honestly, I don't even have a target for crude oil. I just think the moon. Okay, I think they are absolutely going to put the screws to everyone because they had to go through negative $40 a barrel. You think that they're just going to sit back and eat that? No way. That's why we're seeing what we're seeing. So gas prices are going up. Oil prices are going up. Natural gas is going to go up. Everybody's going to have an enormous bill for heating, cooling their homes, and fueling their vehicles. And if you use heating oil, that's probably going to be outrageous too. So in those instances where we have a market maker buy model and we're on the sell side of the curve, we could see models like this in those commodities where it goes down. And even though we have a second stage distribution, it could be a sharp decline, but it's going down to create this longer term bullish scenario, not something like this, where I don't think this is going to be the case for energy prices because they have a lot of money to make. They weren't making money when everything was shut down because of COVID. Nobody could go anywhere. Vacations couldn't be had. Travel was impacted. So I don't think that this is the event that we'll see for energies. I think it is a matter of the opposite. We're looking for it to drop down to pick up a discount to go higher. And it may not even drop down. We might be just seeing parabolic price moves from, summer into, mid-October or something to that effect. Because think about it like this. If you are a company that provides, well, let's say it like this. Say you are a heating oil company and you subscribe to the futures market to keep tabs on when you have to be buying your oil because you have to be a merchant. Okay, you have to buy it when it's cheap and buy it before it gets too expensive. Well, if we're in a climate like we have right now, where energy prices could obviously go parabolic higher, and there's no reason for it to go down, they have a built-in vested interest to make trillions of dollars doing it, then we have to understand that risk. So we're not going to look at this type of event if it's going up to a premium to drop down like this. We wouldn't expect that in the energies. We would expect it to be a controlled demolition where it goes down just to pick up a discount to go higher. But it may not, like I said, it may not even drop. We may just see parabolic price rallies. So it's going to be painful for a lot of folks. But hopefully you've learned something in this mentorship that'll help at least mitigate some of that expense that's coming your way. And none of us can avoid it. And if you have the distinctions made beforehand, before you do your trades, if you're in a bearish market like this, that second stage distribution, always be mindful. Go through and think, are we in a situation that could create this as a crashing scenario? Because if it is, you trade it differently. You don't take the bulk of your trade off here. You take a small portion on it and you just let it ride. And maybe you can get a windfall victory. So if you found this one insightful, until I'll talk to you next time, be safe.